Wednesday, April 27th, 2022, Maneco 64, home of alternative economics and contrarian views. Today, we're going to have something a little different. We're going to be interviewing Rafi Farber about something maybe 6 months ago. No one was even thinking about, not even Rafi or I. And I think it's a consequence of the crazy monetary policy we've seen of QE by the central banks since '08, and that is central bank negative equity on their balance sheet. And we will look at the fact that that could lead to even higher price inflation, to higher or more debasement of the currencies that are actually the liability of the central banks. So the more you will see that the more the central banks raise rates, the more that bond yields keep rising, the worse price inflation will get, the more debased the currency will get, which is the opposite of what they're trying to stop, the inflation. So after the interview, you can also follow where the markets are this morning. I'm going to look at the markets as well. So with no further ado, here's my interview with Rafi. Today, I have the pleasure of speaking with Rafi Farber of the Endgame Investor. You should also check out his YouTube channel, Rafi Farber. Rafi, thanks for coming on the channel. How are you?
I'm doing well, thank God. How are you?
I'm doing well as well. It's weather here is pretty nice. It's still relatively chilly, but anyway, I wanted to talk to you about how rising interest rates and rising bond yields could actually mean the debasement of the currency through the negative equity of the central bank's balance sheet. And maybe if you could go through how it used to be before there were central banks, when people realized that the private bankers were actually cheating, that they were issuing too many promissory notes, and that there wasn't enough money. And maybe you could go through what the money was back then.
Yeah, well, there's a lot of different stages, but we could go back to that level of it. I mean, when people think of central banks, they think of this like fairy tale magical kind of thing that issues money, and the money magically has value, that we magically trade around with each other for real things, and it just somehow just works. But there's no like chain of reasoning back in time to how this actually came to be. There has to be a causal change to something real, because you can't just start trading real assets for imaginary paper that people just say this is worth something and then it just happens. Because if money worked that way, there'd be no such thing as hyperinflation, because then central banks could just stop hyperinflation by saying, hey, stop spending this money for this amount of goods and services, spend it for this amount because we said so, and therefore everything should be fine. But reality doesn't work that way. So when I mean, this is new to me too. I mean, it's new to a lot of people, because this phenomenon hasn't really existed until 2008. So even for those of us who know the entire history of it, it's only like 14, 15 years old. That when that the issuer of the dollar or the euro or the yen is the central bank, so therefore that is the unit of liability of that central bank, and what backs that liability is the assets of that central bank, which is the balance sheet. And most of the assets, only since 2008, the vast majority of those assets are paper, government bonds and mortgage-backed securities and all this stuff that supposedly has value because it can be paid back in dollars that are fractionally backed by gold. That's also on the central bank balance sheet to some degree. The question is to what degree, and nobody knows exactly for sure. But if we take this back in time to, let's say, a bank, not a central bank, but just a bank that would issue liabilities of paper, what would they issue them for? If you had gold and silver and it was too heavy in your pocket and you were worried about being stolen, you would give it to a custodian and you would pay them a fee and say, store my money and give me a receipt for it. And then I'll give you such and such a month or a year to store it for the convenience of storing it with you. So I don't have to worry about the security around the money, which is the gold and silver. That's how it started. And then so the bank would issue receipts for this gold and silver, which is perfectly fine. But that's their liability, the receipts, because when you give, it's a liability. Why? Because when you give the bank the paper receipt that says $1 or $35, whatever it is, it doesn't matter. It's a liability. They have to give you the gold for or the silver for that unit of liability. So that's how the currency became a unit of liability. So when the bank issued too much paper and didn't have enough gold and silver to back it, then they would eventually there would be a run. They would disgorge all their gold and silver. They'd still have notes left, paper notes, which wouldn't be worth anything because there'd be no gold and silver left. But before that happened, you'd start to see the paper trading at lower and lower rates, or higher and higher rates, or higher prices. Prices would be higher in that paper because there'd be too much of it relative to the gold and silver stored in that bank. But it's the same thing with the central bank now, with the Fed, because what is backing the dollar now? That's it's mostly on their balance sheet. Mostly on their balance sheet is Treasury securities and mortgage-backed securities. And when they raise interest rates, they are by definition making the value of those securities lower. And when the value of those securities lower, the value of the stuff that backs the dollar is lower. And therefore, what has to balance is the value of the gold that's backing the dollar. And there still is some of it theoretically. Let's assume it is that has to go higher. So the higher they raise interest rates, the higher gold should go, and the higher prices of basic necessities should go in dollar terms or euro terms or whatever it is.
Yeah, maybe we. Oh, it's echoing. Maybe you could go over what's going on in the government bond market. I think, especially in Europe, they had about a year or two ago, 10 trillion worth of negative yielding bonds, and now it's almost down to zero, and how that would impact the ECB.
Right. So I haven't looked at the exact constituents of the ECB balance sheet. I'm not even sure if it's published, or maybe it is, but we can assume just logically that negative, at least we're talking about negative nominal yielding bonds. I think the highest figure of that, of bonds that nominally yield negative rates. We're not even talking about real interest rates, because almost all real interest rates are negative these days. When you take out you take out the consumer price inflation from the yield, but the tip of nominal yielding negative debt was, I think it was 10 trillion in the Eurozone, from what I remember from the charts that I saw. And we can assume that the end buyer of all that stuff of negative yielding debt is central banks, because they're the only ones with any reason to buy it, because they don't care about earnings, they don't care about losses or anything. They just care about doing their job of stimulating the economy and keeping these like artificial GDP numbers up, so they can keep their positive press. But they don't care about what happens when you do that. So they're going to end up, they have pretty much all this stuff in their balance sheet. So when the value of when nominal negative yielding debt turns to zero yielding debt, the value of those bonds that are pretty much all on central bank balance sheet goes down. So you have the ECB at a negative equity, just like an old bank back in the day would have more liabilities than assets, and they'd be in negative equity, and then the value of its currency would go down because people would be spending it faster and faster, trying to get rid of it, knowing that it's not backed by anything.
And back in the day, I guess it would be you or me and other people realizing that and valuing certain banks' notes less than others. But nowadays, though, there isn't that. It's not like Joe Blogs or John Doe is going to look at the Fed's balance sheet and its bond holdings and say, oh, this dollar is not worth as much. It's the banks that hold those treasuries as well. It's the bankers that are going to see that. And like you said in your video, they're going to get rid of treasuries and buy real things, right?
Yeah. That's how I see it happening. And though none of us have lived through anything like this, we don't know exactly how it's working. There is some element of confusion here, but like in place of the peasants back in the day, when they're the ones that directly had the receipts for their gold and silver, and that's how it worked. Or let's not even say peasants, even nobles or whoever was whoever was storing their money with the bank. It doesn't matter who it was. It was individual people. Now those individuals are commercial banks, and they're the clients of the central bank. And when they see that the bonds are losing value, they'll sell everything to the Fed, and they'll just by human nature, they'll say, okay, what can I buy with all this paper when all the paper is going down? I guess I'll just buy wheat or barley or gold, or it doesn't matter what it is. They'll just buy whatever they can get, just to maintain the value of their assets. And that's when we really have the hyperinflation. It's hyperinflation is really an indiscriminate buying for the purpose of preserving value because there's nowhere else to go.
Yeah, I wanted to show this to you and the viewers because I typed this this afternoon. I got it from Human Action by von Mises, and it's his definition of the crack up boom. So he says, but if once public opinion, and I guess the banks, is convinced that the increase in the quantity of money will continue and never come to an end, and that consequently prices of all commodities and services will not cease to rise, everybody becomes eager to buy as much as possible and to restrict his cash holding to a minimum size. For under these circumstances, the regular costs incurred by holding cash are increased by the losses caused by the progressive fall in purchasing power. The advantages of holding cash must be paid for by sacrifices which are deemed unreasonably burdensome. This phenomenon was in the great European inflation of the 20s called the flight into real goods, Flucht in die Sachwerte, or crack up boom, Katastrophenhause. The mathematical economists, and I put Keynesians in brackets here, are at a loss to comprehend the causal relation between the increase in the quantity of money and what they call velocity of circulation. And I wanted to show you that because I was on Twitter earlier, and I'll show you another thing here. This guy tweeted this out. Let me just get it here a second. Where is I'm going to share it again. And I had to reply to him because you see what I mean. Because there's a lot of people here now, and they're the Keynesians, I think. This guy, Michael Gayet, he's a CFA. He says, get it through your head. Spiking inflation is deflationary. So I replied, doesn't make sense. So it's a non sequitur. Non sequitur is something that doesn't, it's like saying one thing and you can't say that. It's like saying that by putting on weight, you will lose weight. That is, of course, if one looks at inflation as the increase in currency and credit supply, and deflation as the opposite. Any views on that, Rafi?
Yeah, two things to say. You say spiking inflation is deflationary. First of all, like the terms he's using very bad terminology that that on the face of it is contradictory, but I understand what he's saying. Okay, what he's saying is that when consumer prices rise, consumers buy less stuff, and then therefore prices go down. There's an equivalent of that in the futures market. They say the cure for rising prices is rising prices. It's saying the same thing. So like in a way he's right, but he doesn't. This is what he doesn't understand. right? So yeah, inflation, spiking inflation is deflationary. Yeah, in some things, but not in other things. Like rising, let's say the prices of everything rises like 50%. But therefore, like the prices of inelastic stuff that you have to have or you're gonna die, it's gonna go up because let's say like, humongous mansions versus bread and water. Okay, you don't need a humongous mansion, so the price of mansions during a hyperinflation it might even go down or will rise a lot less fast, or might rise.
Private jets as well.
Private jets, or like things you really don't need to
Yeah.
survive, really expensive stuff. They will rise a lot slower or not rise at all, or they might even fall. I mean, I don't know. But you'd have to go through all like, the price indexes of Weimar to figure out exactly what's going to happen. But like, they're not going to rise as fast as food, rice, bread, whatever that people need. Because so then people are going to start plowing all of their money, especially middle class, lower middle class, into the most basic of necessities. So in the end of a hyperinflation, what you're going to see is like luxury items, or let's say silk upholstered couches. I don't know. I'm just looking at my couch and I'm just like coming up with things in my head. Stuff that you really do not need. The prices of those are not going to rise as much because you don't need those to survive. You just need to buy the things that you need right now. So those are specifically the things that are going to go up much, much faster. So yeah, could you look at like silk upholstered couches and I don't know, leather interior cars, luxury cars, and you say, oh, they're not going up so fast, so it's a deflationary environment.
Yeah, but even
no.
if they don't go up, if you don't have any money to buy them, it's no point, right?
Yeah.
Yeah, yeah. And one thing you said in one of your recent videos about the central bank's balance sheet is that one of the ways to pad the negative equity to like adjust for that is that the treasury of the country would help the central bank, i.e., I guess, take funds from taxpayers to put it into the central bank. And I don't think that will work because if things go the way we think they're going to go, and with the amount of debt there is and how overvalued bonds already are, I think it will be a deluge of losses. But here in the UK, they're talking about the UK Treasury helping the Bank of England because they're already getting negative equity on some bonds. And an article came out on this about a month ago. Yeah, I don't think that's going to work. Do you see that working?
No, I mean, I always go back to the most basic logic. Like there's a certain amount of real goods and services on the planet that exist, and printing money is not going to make more of those things. So the treasure, like we're always trying to figure out these like games, like what is the technical thing that could be done to make people rich forever? Yeah. I mean, the whole thing is a stupid game. Yeah. I mean, it's impossible. You can't do this forever. I mean, no matter how clever you think you are, humans are mortal and stuff is finite, and you can't just create goods and services for no work and by just pushing paper around. It doesn't make any sense.
So where do you see the Fed and other central banks? How far do you think they'll go in tightening before they reverse policy? I mean, we have the Fed meeting next week.
I have a simple answer to this question. They'll keep tightening until the banks start to die. When the banks start to die, they'll stop, and then the dollar will die instead. They're the master of all the commercial banks. So when the commercial banks tell them we can't handle this anymore, they'll stop. That's it. They don't care about an inflation target. They don't care about anything except the health of their commercial banks, because their existence depends on them, and they're all in the same. They're linked up in the same chain, so they all fall together, and it's going to be disturbing and it's going to be difficult. But it's difficult for any society when they're released from slavery, because then you have to deal with life, and that's also difficult.
Yeah,
at least you're free to do it.
I remember last year, early last year, you were like one of the first and few people who were saying that CPI, or what they call inflation, was going to be rising a lot from around April. So you've been completely right. So where do you see CPI, or what they call inflation, going, and how close do you think we are to von Mises' crack up boom?
I wish I knew the answer to this question. Uh, um, I have different guesses, and they're data dependent. Let's use that word. They're data dependent guesses, because like they're just guesses. I don't know anything more than anybody else. I don't have a picture of the entire financial system in front of my head. People say that Zoltan Pozar does. I doubt that he does either. He just, that's his brand that people think he does. But like, I don't. They could do anything. They could pull any kind of trick out of their hat to make CPI look like it's going down. I don't know what they're going to do, but I don't care about the CPI. I care about food prices. That's all I care about. Where are food prices going to go? How much of people's incomes are going to be spent on food? When are people going to start panicking that they're not going to have enough food for the month? When are they going to start lining up at supermarkets until they line up at supermarkets and they can't get food? So instead of lining up at supermarkets, they start bashing the windows.
Yeah.
It could be that's the thing. So like we're already seeing like metal chains or metal mesh around like stakes in supermarkets so people don't steal them. When are we going to start seeing like barred windows, or like security guards posted at supermarkets 24 hours a day so that mobs don't come in at 3 o'clock in the morning and break the windows and steal all the meat? That's going to happen. That's going to be the next stage. So I'm looking at food prices. I don't care about the CPI, because they can mess around with things called owner's equivalent rent, or all these other fake stuff. I wouldn't be surprised if the CPI, as they calculate it, goes down for the next 2 or 3 months. But stop looking at that. Look at food prices. When are food prices going to start going out of control? I don't know exactly. Maybe the summer. I mean, there's so many. There's the whole Ukraine situation, and futures and back
Fertilizer prices as well. I remember in Brazil in the late 80s, there's a lot of shortages as well. You'd go to the supermarket, most of the shelves would be empty as well. I think we need to look at that as well.
Yeah, I mean, in Cuba, you can sustain, in places like Cuba, you can sustain this for years, for decades, because that's what people are used to. I mean, they're used to like going into a supermarket and all they see is like canned mango and nothing else. So that's what they eat for a month. But like Americans are not used to this, so they're going to start rioting if they see that. And Westerners are not used to it. Maybe Chinese people are. I mean, they don't consider it that much of an inconvenience. At least they have mango or whatever they have there. I don't know, but just look at food prices. Forget about the CPI. Forget about everything else.
Yeah. Yeah.
How much does food cost?
Great, Rafi. Thank you for coming on today to talk to me and the viewers. Any last thoughts and words?
Last thoughts and words. I try to make it real. We're here. It looks like the world's going back to normal, and it looks like Team Reality is striking a counter blow. It's not going to be. We're not going to win on this. What's happening with Twitter, and everybody knows. So we're coming back, and for now, the difficult thing is that I'm being reintegrated into society while people are trying to deny that anything ever happened.
Yeah,
so it looks like I'm trying to allow them to think that, because we're headed into the next round of this, which is people are going to run out of food, and once they do, they're not going to know who to blame. But we're Team Reality in terms of the monetary reality. Like there was a good chunk of people that understood that what was happening medically was not exactly real. And now there's going to be an even smaller section of people that are going to understand that monetarily what's happening is not exactly real either, because in terms of gold and silver, prices will be completely normal. So track the prices of your food bill in gold and silver terms. And when you're really calculating how many ounces of gold or silver you have to spend for your month, that's when you know that the monetary system is dead, because you'll be calculating things in terms of ounces instead of terms of paper.
Yes.
So that it's gonna come slowly and slowly, and then all of a sudden you're gonna realize that you're not even counting your dollars anymore, or your pounds or whatever. You're counting your ounces.
Yeah, and on my side, what concerns me is that so few people are aware of what's going on monetarily, and that it's going to really blindside them. And like you said, though, on the other side as well of the what happened in the last couple of years, yeah, people are trying to deny it. And I guess there's no point in getting angry with them as well. You just have to try to forgive them and try to help them as well, I would say. So Rafi, again, just before we go, just tell the viewers where they can find your work.
Yeah, just go to Google or any search engine, type in the Endgame Investor, you'll find it, first or second link. It's on Seeking Alpha, or you can be my Patreon at the Endgame Investor, and my YouTube channel, Rafi Farber, and you'll find everything at those links.
Great. Thank you, Rafi. Have a good rest of the day, and I'll talk to you later.
Thanks.
So it's 10 to 8 a.m. London time. I am a little earlier today. Billy and I have been out. It's still very fresh out there. It's been a relatively cold spring so far, or April. It hasn't rained that much either, so it's pretty dry out there. Anyway, we've got spot gold trading around 1900. Actually, it's down about $5. The high's been 1907, the low 1895. Silver's up about 7 cents, 23.57. High's been 23.63, the low 23.42. So I noticed yesterday the miners are still getting a drubbing, and it's not really nice to see your holdings draw down quite a bit, and they have. Am I concerned? No, I think this is just a painful correction after a very good run so far this year. And yeah, it's a matter of buying the dip, in my opinion. Am I going to add to the miners? Maybe a little bit. Right now, my fiat, how can I say, balances aren't that great. So I'm going to wait a little bit. But if I had more fiat balance, I would probably be adding on, I would say. What about the stock market? I mean, we had a very interesting day. Just look at this chart of the NASDAQ 100. This is a huge head and shoulder formation, and it doesn't look very good. And many people are wondering, with the Fed making a decision at its FOMC meeting in a week's time on the 4th of May, to raise rates maybe by 50 basis points. How worse could this get? I mean, so far they haven't even started unwinding their balance sheet. They've only raised by a tiny 0.25%, and this is what we're getting already. So as I look here, year to date, now the NASDAQ is down just over 20%. So in a year to date basis, it's supposedly in a bear market from the high in late November last year, all-time high. It's definitely in bear market territory. I mean, I don't hold those rules like the 20% rule. I don't hold that really as a solid base to say we're in a bear market, but a lot of people do. The Dow is down about 8.5 year to date, and the S&P about 12.5. So yesterday, yeah, the Dow lost 800 points, 809. The NASDAQ lost almost 4%, which is I think that's the biggest drop percentage terms this year, 514 points, or maybe since the beginning of the year. I'm not too sure. So where are we this morning then? on the futures. While the Dow futures rebounded a bit, it's up 265, just over 0.75%. The NASDAQ 100 futures up 0.5% or 67 points. The S&P 500 is up 25 points, 0.2%, just below 4,200. The FTSE is up 24 points at 7408. The Euro Stoxx 50 is up 7 at 3723. To the currencies, yes, the dollars continue to strengthen, especially against the British pound. Just look at this chart. It doesn't look good at all. The British pound, there might be a little bit of a short-term bounce, but I calculated, I think the pound has lost about 6% versus the dollar year to date. That just goes to show that the Bank of England is behind the curve as well, even though they have raised rates a couple of times. Anyway, right now, the pound's down slightly at 125.68. The euro is down about 1/8% at 106.22. The dollar is up 2/3% versus the yen at 128. And the dollar is down slightly versus the yuan at 658.54. Yes, I am aware of all the events in China with lockdowns and COVID. It looks like this could have a big impact on their economy and our economies as well. The supply chain could get even more disrupted. So that's another thing to keep in mind, aside from the monetary inflation. So it could get ugly later on this year, definitely. The dollar, by the way, is up slightly versus the Swiss franc at 96.40. So pretty strong dollar there for the moment. Against the Aussie dollar is up 2/3%, 71.68. The dollar is down 0.2 versus the Canadian at 128.01. And the Kiwi dollar is up 0.2 at 65.72. To the general commodities, WTI crude is up 0.75% at 102.10. Brent is up just under 1% at 105.55. High-grade copper is up 0.5% at 448.50. U.S. nat gas is up 1.5% at 707. And to finish off, just quickly look at the bond market. The 10-year yield is up 1.2 basis points at 2.784. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And I wish you all a great day. Take care. Bye.